Hey everyone, this is Finding Value. I'm going to go over a very important clip. This is going to touch every single investor if you are looking to investments. And this is a lot of information here about how you have to condition yourself and train yourself to be disciplined enough to be a good investor. So I'm going to go over a couple of things that new investors kind of know or don't know, but really what they know as a new investor, what kind of the preconceived notions are of being a new investor and what I thought when I was a new investor. And then I'm going to go over things of what I had to develop through time to become a much better investor. And some of these things are very difficult to do, and I'm still trying to master them. So let's jump in. Let's see what I've got here. So I call it building wealth, and you have to have a certain mindset to build wealth. As a new investor, this is kind of what I thought everything was about as a new investor. It's buy stocks, be aggressive. Especially when you're young, it's okay to be more aggressive. Well, perhaps maybe going in less aggressive stuff, compounded over a longer period of time, does well as well, if you think of it from a different perspective. Also, I was listening to others because obviously they have invested for a while, so I thought they knew a bunch more than what I did, and that's obviously not the case. I listen to my parents. I have much respect for my parents. I love them very much. But from an investment standpoint, I think they're very good at saving money, very good at deploying money, but not very good at choosing investments. So a lot of people said, go buy a house. And remember, I started in the 04, 05 timeframe when I started working. I moved jobs in late 05, and in 06, everybody's telling me to buy a house, and that's the peak of the housing market. So it's and I didn't buy a house, so that's a good thing. But it's important to understand the cycles and what the relative value is when making a large purchase like buying a house. And I also thought when I was a new investor, and I think it's still true, is invest as much as you can and as early as you can to get the compounding. So everybody, when you're new, you're so worried about compounding the investment that you're not focusing on where you can get the best returns, which can make a world of difference if you know what you're doing, between a completely, I don't know anything investor where you just drip money or cost average into an S&P 500, stay in the S&P 500 for 30, 40 years, and then you get to retire. I just couldn't do that. I want more returns. I want to be a lot more aggressive, but also reduce the risk, meaning that you know what the heck you're doing. So this is what it takes to build wealth. Number one is you got to be patient. This isn't going to happen overnight. You need to choose investments where the wind is at your back, where everything is pushing you forward and you don't have to do as much work. So that means that you have to time your investments using ratios. And I'm not talking about day trading. I'm not talking about weekly trading, swing trading. I'm not talking about anything of trading. I'm talking about investing and identifying secular trends. Secular trends are trends that happen 10, 20, 30, even up to 40 years in length. One trend, to give an example, is lowering interest rates. From 1980, we had very high interest rates. They lowered those interest rates all the way down to almost zero. Well, it's zero now, but it could be even negative. So that's one investment trait, and bonds had a tailwind behind it during that 40-year time period. And obviously going forward, that might be changing. So this channel is providing the information to get the wind at your back for your investments. The wind at your back. So we want to look at ratios, we want to see relative value, find what's cheap, and invest in what's cheap. Again, buy when investments are cheap and hold till they are expensive. I don't think you understand how difficult this can be. All it takes is one day where your emotions run you and you get a little bit scared and you sell out. 50% gains, no. You could get a 50% gain, sell out, and be like, yeah, I gained 50%, and then you watch it go to 5,000% gains. You're like, man, I messed up. That happens all the time when you're a new investor because you don't know what the relative value is. This channel is going to help you identify that value, and we can ride these things together on this channel and find good companies, find what's cheap, learn how to identify what's cheap, and then ride it through the entire way. I've got a quote here. Pigs don't get slaughtered because we are not pigs. We are sharks swimming in a tank filled with fish we can eat. That's the difference. Pigs don't know where they're at. They don't know the cycle. They don't know the ratios. They don't know what's cheap and what's expensive. A shark walks into a set of water with a bunch of fish and starts eating all of the fish because we know where the fish are at. We know which tank to go into, and we know that that is a good deal. Again, don't listen to your friends, your family, and even yourself sometimes if you've got high in emotions. Stick to the plan. And the plan is to identify those undervalued assets. And then you buy those undervalued assets and you hold them till they get overvalued. It is that simple. You cost average in, you cost average out. Cheap to buy, expensive to sell, if you even sell. Sometimes selling is too early. Just selling at all. It depends on what you're holding. Also, if you're a new investor, everything you do will feel like you just keep getting kicked in the nuts. You need to buy when everything looks like SHIT. And what that means is new investors want to chase. They want to chase returns. They want to chase whatever's hot. They want to chase Tesla. Don't chase Tesla. They want to chase all of these things. Chasing will get you in a world of hurt because it'll chase you and entice you to get when you're buying at a top. You want to go chase it, and then you lose money as it goes down. It happened to me when I was a new investor. This channel is here to identify what's cheap. Now, if you identify what's cheap, your friends are going to tell you not to buy it. Your family's going to tell you not to buy it. And yourself, you're going to doubt yourself. You're going to say, well, why? This is down so much. Why would I buy this? Why would I buy oil and natural gas right now when it's down so far? It's like, exactly. No one's buying this. Nobody likes it. Everybody hates it. That's something that you want to get into. So, as a new investor, if you don't take this advice, it's going to feel like you're getting kicked in the nuts all the time with you losing money all the time. And it sucks. Trust me, I went through it. Also, keep in mind that being wealthy is rare. You don't have a lot of wealthy people around you, and they're going to give you probably bad advice. I'm not saying that I'm this ultra wealthy person and my wealth has increased quite dramatically, but be careful who you listen to, because a lot of people pretend that they're wealthy, and maybe your perception is that they do have a lot of wealth, but they're probably not. Also, another thing to keep in mind, when you hold shares in companies and no one is investing in them, usually it's at a bottom. Sometimes they can be pretty illiquid at bottoms. But at tops, it's another sign saying that they're always liquid at tops because everybody wants your shares. Lots are trading. Once you understand and retain yourself to not chase investment returns, you have finally gained the discipline to deserve wealth. Once you recalibrate yourself to value things and buy when they're cheap, when nobody wants them, that is when you will, number one, that is when you deserve the wealth, and two, making a ton of money will be exceptionally easy. It just takes time and patience. Also, wealth must be earned, and it takes time. Nice. This channel hopefully accelerates that journey of you creating that wealth for you. Rich people buy when it's cheap, and most of them never sell. And this pertains to stocks and businesses and companies, not so much to commodity-based things because they are very cyclical. But in businesses, I have found that you buy something when it's cheap and you just never sell it. You just put it away. And those are companies that control the sale price of whatever that business is creating. So I have diversify into the cheap assets. New money, which is new money that you've earned from income that you're deploying in investments, should always seek cheap assets. Avoid putting new money into expensive assets. So what happens is we see these cycles and they go up and down against each other. If new money always seeks the cheapest assets and you diversify against those cheap assets, you will do incredibly well over time. And also, this is for stock or businesses. Always pick, at least in my opinion, always pick the obvious picks for investments in normal stocks. And what I mean by that is when you go out and you look in this world and you see companies killing it, just put money in them. Put money, find them when they're down, put money in them. Chick-fil-A, I know they're private, but that's one company I see growing like mad. It's always slammed at Chick-fil-A. Roku, I'm seeing these TVs in Walmart. Everything has Roku on it, everything. And all the reviews are really good on Roku. So it's like, that might be a good one to go into. Chipotle. I went into Chipotle at $54 when they first went public. I sold out too early. I was a new investor. I knew they were going to do great. I should have just held on. If I held on the entire way, that would have been exceptionally good, over a 20 bagger. Visa, MasterCard, Nike, these are all very large companies that do extremely well, and people, they don't even think about swiping a card. They just do it, especially with COVID. So what I'm getting at is, with all of this, is you gotta create a mindset. You have to know what's valuable. You buy when things are cheap and nobody wants it. Another thing to keep in mind, always keep maybe a little bit of cash, and I struggle with this myself because I always want to be 100% invested. When things are all expensive and you don't find a deal, just stockpile cash until a deal comes. In March, maybe you see assets that didn't fall very much, but then you have other assets that fell a ton, but they're good. So some of those very volatile assets, you want to redeploy your money from one that held up very well and put more in the undervalued asset. Then when that asset appreciates a whole bunch and it starts to look a little bit overvalued, you swap it back to the other asset. These are all strategies, even on how you bet on companies. If you know that something's going to go way up, like a commodity sector, maybe it's not best to put all your money in one company. You want to sprinkle it amongst 4 or 5 or 6 different companies that all exhibit very good business models. Maybe they all have high insider holdings. There's a lot of things that you can do in terms of the strategies to deploy cash that reduces risk and increases return. This channel will go over all of those things over time. Obviously, I'm creating a whole bunch of videos on all this stuff, and I just don't have all of the time to do it all in one shot. So over time, I'm going to be releasing all these things, and they are exceptionally valuable if you decide to listen to them. So hopefully, this is just at the tip of how you become a better investor and how you can really build wealth, and it's really with your mindset. You have to change your mindset, and you have to look at the world a little differently. You're going to have to change your paradigm just a little bit different than what you've been doing if what you've been doing hasn't been working. This is Finding Value. Hopefully this is a valuable clip for everybody. Subscribe, comment, and thanks for listening.